Hello, everybody, and welcome. I'm Toby Gennaro, and I'll be your presenter for today. The topic for today is mental barriers, and we're going to take a look at the outlook on gold, silver, and then some other commodities and look at the live chart. So I'm going to be talking through, just all of the technical analysis that traders will use to identify, various trends and barriers, entry and exit points related to a trading strategy. So this will be sort of an entry-level session, help you guys understand the fundamentals of how to analyze charts for using technical analysis tools that comprise a trading strategy as your documented blueprint. So I'll go to the CTrader platform here in a minute. We'll look at some live price action, see some examples of what we can do with the type of price action analysis that we're doing here. For those of you that are on the live webinar today, if you have questions during the session, you can type those into the question box on your screen. I'll be asking you some questions as well, so we'll definitely try to keep this interactive, okay? So I just need to put up the risk warning and disclaimer. Got to do this as part of the business. I'll leave this up for about 30 seconds or so. If you could just have a quick read through, that would be great. What this is saying in brief is that we provide education only, which means we do not give any financial advice. And as most of you know, trading the markets can be risky. It's not suitable for everyone, and you should seek independent professional advice. All right, everybody good with that? Give it a quick speed read. Okay, so for the agenda today, we will be discussing the concept of mental barriers and the effect on commodity markets like gold and silver, and we'll take a look at some others. We'll go to the live platform for the majority of this session. We'll look at live price action for any potential future trading opportunities around gold and silver and some other commodities. And then we'll take a look at a variety of different commodities markets and see what setups might be occurring in the price action for us. Okay, sound good? So let's go ahead, we'll get things kicked off right here. I'm gonna jump right into the platform, ICTrader, show you guys how to get the platform set up properly for trading and then walk through some of the items I just talked about in those markets. So just give me a minute here to get my screen set up so you guys can see everything. And I'm just gonna drag this over here. So you should be able to see the platform and the charts that I have up. So that should all look good. Now, if you're not familiar, this is the platform that's offered by ICM. I find it to be, I think a lot of the web-based platforms now for trading are actually quite good. They're very fast. They have a lot of the functionality of, the desktop systems from yesteryears. So this one is actually pretty good. I like the way it sets up. It has, and let's kind of walk through the setup on how I do this, in my own trading, and then you can take a look at that and see if you want to adapt it. But for the most part, the trade strategies that I use and what we teach at Trade with Precision, I like to use two 24-inch screens, and then I'll have multiple time frames. Like here I have a weekly and a daily. I'll usually set this up along with my my market watch list. I usually have a weekly, a daily, and then probably an 8-hour on this screen, and that'll give me 3 time frames. Then on my other screen, I'll go from a 4-hour to a 2-hour, and then a 1-hour, and then a 30 and a 15-minute. And so across 2 screens, I'll have anywhere from 6 to 7 time frames. And then you have to click on this little box right here and just make sure all of them are selected to the common color. And once you have all of those selected to the common color, you can go here and you can click on your watch list, and then all of the charts will change with each and every click. Okay, and then you have the advantage of just looking from high to low, from looking all the way from the weekly, the daily, the 8-hour, all the way down to the 15-minute. You can see all the time frames, and you have a better ability to identify where the trends are in the price action, where the key levels are based on some of the high time frames, which will give you those key levels. We'll take a look at those in a minute. And that's really, I think, some of the best ways to look at the markets technically, and then to utilize a trading strategy that way. And all of the the trading strategies that we teach, and even the ones that we teach for ICM, are going to be based on a trending chart structure. So we're looking for the most advantageous price action that we can look at. We want charts making either higher highs and higher lows, or lower highs and lower lows. And if we can find a good, nice trend going either higher or lower, then we're going to start to look for our trade strategy to jump in on that. So that's kind of how that works. One of the other things, if the trading platform setup that I just showed you from the weekly down to the 15-minute, that's pretty much going to be like a swing trader setup, which is what I do mostly. Some other folks prefer to do intraday trading. In that particular case, you'd set it up a little different. You would just change your time frames from weekly and daily down to like a 1 hour, a 30-minute, a 15-minute, a 5-minute, a 2, and a 1 minute, and that would be more of an intraday trader setup. So from that perspective, always want to be trading in the direction of your anchor chart, which in that case would be the probably the 1 hour chart, even a higher time frame like a 2 hour chart. So if you're trading intraday, going in the direction of the higher time frame gives you the best probability of finding a trend, going in the right direction, and ensure that you're not trading counter trend with the higher time frame. Okay. So those are just some things. Another couple of things on how we have the chart set up. If you're not familiar with our trading strategies that we teach and how our chart setups are technically, we utilize 4 moving averages: the 200 in green, the 50 in red, the 20 in blue, and the 10 in black. So the 200, the 50, the 20, and the 10. And then we also use 2 other oscillators. We use the MACD and the RSI. Now, we're not using these as normal folks would use these. In other words, we don't trade the line crosses of the 10 and 20 period moving average. That tends to be a lagging indicator. I know a lot of folks will teach that. We use the moving averages primarily as in a geographical type of format. When they all start, when the market comes out of like a tight consolidation, like you see right here, usually it'll break out of that consolidation, either to the upside or the downside. And then all the moving averages get really tight and compressed within that consolidation. And then when the market starts trending, they start to fan out in numerical order: the 200, the 50, the 20, and the 10. And then as price breaks out from that consolidation, you'll start to see the higher highs and higher lows start to trend upwards until it reaches some point of either resistance or some point where the trend is tired. Then you'll have a pullback in some type of a consolidation or potentially a trend reversal. So that's typically how we're using the moving averages. And then again, we're not using the MACD or the RSI like it normally is used for folks where they're actually trading the line crosses here. And so right here, folks would be trading the line crosses looking to go long, or trading the line cross here and looking to go short. That tends to, again, be a lagging indicator, the same way as the RSI. If you're fading the 70 level or fading the 30 level, that tends to work well in a ranging type of market, right? A sideways market like this. Same thing with the MACD, but it doesn't give you a good trending structure. If the charts are trending in a very strong trend, then typically the RSI is going to be bumping up against this 70 over and over and over again. And it's going to be trading between this 50 mid mark and the 70 level up and down, and that's going to be basically an uptrending chart. If the RSI is trading between the 50 level and the 30 level, then that's typically going to be a downtrending chart. So if you're constantly fading this level, the market's in a downtrend, then it's going to be continually bouncing down on this 30 level, and the rallies off of that 30 level are just not going to be very good. So again, the 2 oscillators only typically work well for the way these different indicator setups occur when the market is in a sideways ranging, and that's usually going to be the worst time to trade because there's really no price predictability in the chart structures that we're looking at. And we're going to go ahead and take a look at some of these commodities like gold and silver and some others. And and kind of show you how to look for trends and kind of point out when the price action is just not good for trading. And then you can take some of that and see if you want to go on to some of our strategy courses, and we'll show you the different strategies that we teach and how we do this. But I'll demo a couple of these for you today. If you don't understand everything that I'm talking about, don't worry about it. This is really just kind of an intro and just kind of helping you to understand, how we analyze charts technically, and we're going to do that with the commodities today. Okay. Any questions on that so far and everything that I've described? Everybody kind of clear on what we're going to do? Don't expect to be completely up to speed on everything I'm talking about if you haven't taken some of the strategy sessions, and don't worry if you don't know the strategies that I'm using. I'll do my best to describe those at a high level, but I don't want you guys to get the opinion that you can take these strategies from here and then trade them with real money. We haven't educated you on everything that the strategies are about and how to use them properly in real time, but I'm just trying to give you a little taste for what you can do and typically what professionals will do and how they'll trade with a trading strategy. Okay. All right, so we are currently on the gold charts. As we promised at the beginning, we're going to take a look at gold and silver, see what's going on there. I haven't been, in all honesty, I haven't been a big fan of gold and silver for quite some time. I mean, there was a breakout way back around and a consolidation like around the 11 to 1300 range, and I was calling the breakout at 1300, and that resulted in this run up to where it is. But for a long time now, the market for gold and silver has just been really in a quandary, really kind of a sideways market. As you can see, if we went up to the monthly chart, we can see that even more. Oh, hang on, didn't want to do that. Let me go to this one. Same thing, same chart. But here, if we scroll back, you can see the previous time that we were up to 2000 was just before, I believe that was probably right around 2008, I'm guessing, somewhere around there, maybe 2010. And so we reached up right around that 2000, 1900 level, and then we started to roll over. And as the market gained steam in terms of equities and other financial markets, we got that big rally from 2000, 2008 crash all the way up to the current, basically as of last year, almost a 14, 15-year rally, unprecedented in the markets. And that's when gold started a retreat. And so it retreated all the way down to, past the 1100 level, started to consolidate right around, 2017 through 2019. You can see how long the markets can consolidate in that range. All the moving averages are tightly bunched up and squished together, and until we get this breakout, and the market's basically set up a flat level right here. Touch number 1, touch number 2, touch number 3. We only need 2 touches on a flat level, but a lot of times you'll have a 3rd touch and even a 4th touch, maybe even a 5th touch before the markets actually break out. And once they do break out of that range, usually they'll run for about the width or the depth of the consolidation, which means here's the low of that consolidation and here's the high. And usually the market will at least be symmetrical and run at least up to that level until there's a pullback. And that pullback ran a little bit longer than that, and that cold pullback occurred right into here, and then the market continued to run all the way back up to that previous high of around 2000, almost approaching the 2100 level. So that was the last good consolidation opportunity. Here is where we're at right now. If we just had 1 touch at that 2100 level, I wouldn't be as worried about it. But the fact that we pulled back, set up, some bullish candles here, and then did a retest of that level with a lot of divergence on the MACD and the RSI. That's how we're using these two, is when price continues to trend with higher highs. If the MACD and the RSI are putting in lower highs and price is going higher, then the trend on price is up and the trend on the indicators is down. That consists of bearish divergence. And all that means to us is that the trend is potentially weakening. And usually any type of a double topping structure in the markets like this with a big rejection candle like that, and then candles moving down, usually that will signify, along with a lot of bearish divergence here on both the MACD and the RSI, that will signify usually a reversal pattern. I'm not predicting this right now, but usually what will happen when it breaks down off of this, it'll come down, it'll break this neckline right here, and then it'll move down to a level that is equal to the high and the neckline, which would probably put us right back into this level, that flat level that broke out earlier, probably around 1300. Now that's just looking at primarily what the the technicals. I'm not saying that's going to do that, but that's what the technicals would suggest. Since the markets are pulling back, and since we're most than likely going into some type of a global recession, I wouldn't anticipate that type of a market response for gold. I would expect gold to probably hang around here for a while and probably trade between these levels of 1700 and 2100 for the foreseeable future. I wouldn't necessarily be interested in this until maybe it retested this 1700 level, and then I can get a little better idea of what that support level looks like to see if there might be a range move up to that high again to retest 2100 and to see if we put in even more divergence. Right now, we only have one divergence bump. A lot of times it'll take 1 to 3 divergence bump, meaning several higher highs in price in order for this to actually, be a market reversal. So that's kind of what things look like, but this isn't a great pattern to trade off of right here on the monthly chart. But for the foreseeable future, I expect that more than likely gold will trade between 17 and 2100 for the foreseeable future until we have a recession in place. You'll see a lot of layoffs in companies. You'll see a lot of bad economic news in different countries around Forex and foreign currency pairs. You'll see once that happens and the recession has played out, then the equities markets will start to trend higher. Companies will start to make reinvestment, and then you'll all of a sudden start to see gold potentially start to maybe break this 1700 level and retreat lower as the financial markets tend to move higher. So gold and silver alike tend to be the type of asset where they do well in times of economic turmoil like we're seeing now. A lot of uncertainty, folks kind of tend to rush into gold, and that's kind of where we're at right now. So I would expect this to be kind of a constant going forward. I expect a lot of volatility across all the markets, both foreign currency, commodities, as well as equities, and that's just kind of how things work. All boats rise and fall with the tide. So that's the monthly chart, which is in an uptrend, no question about it. All the moving averages are in alignment. So for that to turn around would take a lot more than one divergence bump on a MACD and an RSI. So if we go down to the weekly chart, then all of a sudden we're seeing that most recent consolidation, that double topping structure occur right here with just a lot of sideways market movement. And so this is just very choppy. I'm not interested in trading this at all. It doesn't give me any kind of a trend to look at. And it doesn't give me any price predictability in the market that I'm looking at right here. The daily chart, the same thing. It's flat across. All the moving averages are out of alignment. They're all bunched up. Same here. That is indicative of a trend that is not worth trading. If we go to the 8-hour chart, and even the here we'll go to the 4-hour. So again, more than likely, most of these charts are going to be going sideways, and these are just charts that are not worth trading. Go to a 2-hour. Sorry about that. The 2-hour and the 1-hour, see what that looks like. Still, everything is in a sideways movement. And then if we went to the 15 and the 30-minute, we might start to see some trends just based on the high and the low of that consolidation on the higher time frame. So if the higher time frame is a sideways market and you go to lower time frames and you see trends like these beginning, more than likely you have to be very aware of the bottom of that consolidation on the higher time frame, because you might be in a trend here, but as soon as it hits that level, it's going to reverse and then it's going to go back up and test the upper level. That's why you don't have good opportunities to trade these sideways markets, because once you can identify the trend and everything sets up, then by that time there's very little room for it to run. So the market's going to force you to fade the high and to fade the low. And if you don't know what you're doing and you don't understand price action, then at some point, depending on the higher time frame trend, price is going to set up a flat level, maybe to the upside, and then it's going to break higher, or it's going to set up a flat level to the low side and break down lower. And so those are the things that you have to be concerned about. So folks that are just fading these highs and lows, it might look easy on the chart, but at some point you're going to get caught. And when it breaks out of these highs or lows, it's going to run pretty hard. And if you're not using a stop loss, that's going to be pretty painful for you. So again, we can keep going lower and probably find some trends even on the 5-minute. But again, these aren't really worth trading. The low down here is below, at 818 level, maybe even the 1700 level. But I wouldn't be looking to short gold at this point with a lot of economic turmoil happening and that 1700 level looming here below on some of those higher time frames wouldn't be a very wise decision either. So right now I would be interested in looking at something else other than gold to see if there are opportunities within the market potentially in commodities. And usually when we see that, that's something that we're going to identify as as something that, there's always a market that's trending, regardless of whether equities are, going down or whether we're in a recession. There's always going to be something that's going to be moving. Very simply, like oil. We'll take a look at oil here in a couple of minutes. Crude oil has been on a miraculous trend. I was involved in that for the last year. I got out around the 85-90 level, and it really just took off with the war in Ukraine and has been up around the 120 level for crude. So we'll take a look at that once we get done looking at silver and show you some of the different opportunities where a lot of other markets could be stale or could be headed downward, and yet some other markets like energy, even natural gas, can be moving really well. So let's take a look at silver. Silver's been hovering, the same as gold. It peaked right up here around this 30 level. Let's go back to the monthly and see exactly where that was. So right up around 30, that's still a little bit lower than what it was a number of years ago, probably 10 years ago. It hit a high of, I think, of around 50. We can just cruise back here, and 50 was right there. That was the high back around 2010. And once the market started to recover from that 2008 fiasco, then everything started to descend into a bear market. And so went into a period of consolidation, just like gold did. And then once it consolidated, didn't really set up a flat level that's actually tradable. So I wouldn't have been interested in trading this. It actually took a pretty big move down right here, probably around the pandemic era, and then shot up to 30 because of all the uncertainty around the pandemic. And so that's kind of the same as gold. Whenever you have that kind of uncertainty, countries are shutting down, business across the board. Very, very scary type thing, and a lot of people start bailing out of the markets and moving into precious metals for some type of security. So here, similar, we've been at a top of 30. We've double topped that twice, and then we've been touching down here around 21 pretty consistently. Looks like there might be an opportunity. That is a pretty solid level right there with many touches around that 21, 22 level. Don't expect the market to move much lower. I would expect probably a similar range between 30 and 21. I think, we're certainly headed into a potential trough in terms of an economic downturn here in the U.S. Countries just like the U.S. have borrowed a lot of money. The dollar is weak, and so there are a lot of things to consider here. And this isn't something that I'd be interested in fooling around with, because there's just no solid trend that I can identify in the price action, and there's really just nothing that I can follow here. Okay, and this would be then the same if we looked across all the lower time frames. If anything, this is setting up a flat level potentially to go lower. All the moving averages are in alignment, and we have a swing high, a lower high, and then even a lower high with a rejection candle there. Even though it did reject that flat level breakout to the downside, that may be telling, but overall, there's no way for us to identify based on a trend, what's going to happen in the price action here on silver. So as far as the MACD and the RSI, nothing really to speak of right there. We don't really have a lower low as of yet. But if we did get a lower low, more than likely we would start to see some divergence here, which would keep the market from dropping any further. And then I think the economic turmoil would prevent that as well. So that's kind of the outlook on gold and silver. And that's how folks kind of look at these price barriers between 21 and 30. And so keep those in mind if you are planning to trade this and you're using maybe a different strategy other than I am. Make sure that you understand those levels between 30 and 21. Those are going to be very stiff price barriers for the foreseeable future until we actually go through a recession and then potentially start coming out of that recession. Then more than likely, these markets, after they've been consolidating across for a while, they will more than likely set up a flat level and then break down. If this turns out to be not a recession, then again, more than likely, the price level would break down. Okay, if things get worse and the market continues down further, then more than likely you'll see gold rally or silver rally up to this 30, along with gold rallying up to that 2,000, 2,100 level again. But I don't see a real strong move here either way, and it doesn't really benefit to guess. All right, so let's take a look at some commodity. If you guys have any questions, shoot those over to me based on some of the technical analysis that we're talking about here. Let's take a look at oil and see what that looks like. Let's see. Let's go to energies, and then we'll take a look at crude. It's been hovering, hit a high of, I think, a little over 120, maybe 122, something like that, a while back. Actually, it was up around 130. And so on the monthly chart, you can see the move and the crash back at the pandemic. And that's when some of the futures contracts actually, or the current futures contract for that month went negative. And you can see the bounce that occurred off of there. That was really just an unprecedented bounce in crude oil. Normally, if you know anything about crude, the fundamental is crude oil exploration companies need price to be right around $30 or higher in order to continue investing in crude oil exploration. It just doesn't make sense to invest in production and extracting crude out of the ground if the price you can sell it for is $30 or less. So, whenever crude gets below 30, that's usually going to be a buying opportunity. And then usually over time, it'll break that 30 because of production cuts and various other things like that that are fundamental in nature. And that will then start to create an uptrend. And then as everything starts trending, we start to get everything in alignment, 50, the 20, and the 10, higher highs, higher lows, and all of that starts to look very good for movement, usually back up into the 80, 85, 90 level. And then there's a lot of demand destruction that typically occurs around 85 or 90 and even higher, especially up around 120. So overall, it's been a fantastic trend. And so even though a lot of other markets are trending to the downside and selling off, energy has just been making some major moves to the upside that'll even show very nicely in a trend on the weekly chart. Now, based on the sideways charts that we were looking at, you can see here very nicely how the moving averages are all fanning out in order, and then all of these pullbacks are occurring in the buy zone between that 10-20 period moving average. So for professionals, any pullback into a moving average zone with this type of a trend structure is just a buy as a standard operating procedure. So folks that are, trying to buy pullbacks, but they really don't know how to do it, this is a great pullback strategy to look for the fanning of the moving averages, look for a nice higher high, higher low, and look for a 45-degree angle on the price action. This isn't exactly 45, but it's pretty close. And we have really a nice movement and a nice uptrend happening here. And so the pullbacks here aren't necessarily occurring in the, I like to see them in the middle of the 10-20, but for the most part, we're getting some nice bullish candles in and around there, and the moving averages aren't crossing over. They're still stayed aligned to the upside. Sometimes they might touch, like in this case, we'll get a couple of bullish candles. Once you get a break of the high, stop below the low, then all of a sudden things really rocket and take off. And the reason you get all of these green bullish candles is because a lot of people that know how to trade and know this pullback strategy understand how this works. And so you want to put yourself on the right side of the order flow. And by doing that is understanding pure market price action and how these pullbacks trend and occur. So that's how that looks. So I like crude oil, but I don't necessarily like it at these extended levels here. We might be getting on the weekly chart. We've already got kind of a small rejection candle right there. We might be getting another candle setting up here. A bullish candle, we'll know that by the end of the week. So we might end up getting another run at least up past this 120 level. And as long as that, war is going on in Ukraine and, Russian oil is off the market, there's going to be tight supply, but you always want to be aware of things that OPEC is doing, things that, U.S. oil refineries are doing in terms of opening up production, expanding production to increase that supply will then have its effect on depressing, prices for oil. So here on the daily chart, you can see a trend here. Nothing really to trade off of there. We'd really have to look at, it would really be the monthly and the weekly chart that I would be looking at. And we would need, a setup across two time frames side by side, the weekly and the monthly, both trending the same direction, seeing a bullish candle here. And then once we get a bullish candle here and a break of the high, then we'll start to see a lot of the charts below, like the daily and then possibly the 8-hour, start to re-engage the trend as well. All the moving averages will start fanning out again as well. And so that's kind of what things look like on oil. From a trend perspective, this is what I was talking about before. If you're fading the RSI, this is what would be happening to you. Instead of being on the right side of a trend, by fading the 70 level, you would be on the wrong side of this trend. You would be shorting, shorting, and shorting, and there's just no money to be made on these small shorts. The pullbacks are very shallow, and the runs to the upside are a lot more and more consistent. So we don't have a ton of, we have some divergence here, but we don't really have a retest of that 130 level or a breakout to a higher high. And so things still look like they can still continue to move higher, provided that OPEC doesn't increase production, and a lot of the OPEC countries don't start to increase production, which would depress prices. So right there is about one of the setups that we could start to look for. You can follow that to week's end and see if we get a nice bullish candle right there, and then a break of the high would mean prices potentially are moving at least back up to this level, if not a retest of this level, and then stop would be below the low. So again, there's no guarantee on any of these types of setups. That's why we have to use a stop loss. And on a weekly candle like this, that would be a much larger type of risk level. I would like to see that set up and then go down to a lower time frame and then trade it on a lower time frame so I can have my entry and my stop a lot closer together. Okay. So we can go down and take a look at the 8-hour chart and then the 4-hour chart, see what those look like. So you'll start to see we haven't had that bullish candle set up in the on the weekly chart, but it is slightly bullish. So that means if you go down to like the 1-hour and the 30-minute charts, you'll start to see those trending as well. And so once that candle closes out, if it closes out bullish, then you'll already have trends established, unlike the 1-hour, the 30-minute, the 15-minute, maybe even the 2-hour. This isn't a great looking trend, but this one I like a little bit better. If we had the 2-hour setting up maybe by the end of the week, the 1-hour and the 2-hour would probably definitely be some better looking trends. And then pullbacks into that moving average zone would look pretty well. That's the way that I would play it. So that's going to take until the end of day Friday, and then next week Monday we might have an opportunity to see what this trend looks like and if it has a good opportunity for continuing. So everything here is trending to the upside. Price is making higher highs along with higher lows, and then the MACD and the RSI are making higher highs along with the higher highs in price. Okay. And then maybe the last one that we'll look at here is going to be on natural gas. Natural gas bottomed out quite a ways back, and I think it was right around like 2. That was back, I think. Wow, back actually it went to 1. Wow, I didn't even see that back in 2020 at the pandemic. Before that, it was when they did a lot of the shale production, and a lot of organizations and refineries were converting. Price was in around that 2 to 3 range for a long time, and until it finally dipped down, really bottomed out like oil did at the pandemic, and then just shot up from there. I mean, all the way up to 9, almost 10. So that was huge. Not really a tradable type of thing, unless you're just looking down here saying there's really no place for it to go from a lower perspective, just like oil really had the same type of reaction here. Now in this type of level, a lot of big candles, don't really like trading off of that. The time is actually kind of past. But if we go down to the weekly chart, we can see a nicer trend right here. All the moving averages fanning out, a pullback, a bullish candle setting up in the buy zone right here. And if we go to the daily chart, might see another trend setting up. There was a nice trend, and all the pullbacks were occurring in the buy zone with these beautiful little bearish or bullish candles right here, trending up very nicely. 45-degree angle, perfect, really nice trend to trade right there before it rolled over. And then if we're looking at something like an 8-hour chart, that's probably still going to be down. And then a 4-hour chart is going to be down until we probably get to maybe the 2-hour and the 1-hour, just like on crude. Then we might start to see an uptick. So the 1-hour and then the 30-minute is where we're going to start to see that change in trend. Now you can see with all of these retests of this low, all the divergence that's happening here, and that's what technically creates that bounce. You can see that here as well. The higher lows. Same thing here on the MACD as price retests these levels and sets up a lot of divergence. Really tells us that the market's more than likely weakening in the trend. It doesn't mean it has to reverse, but a weakening trend means we just don't want to trade it short anymore. And so in this move here, we've got the 30 and the 1-hour. We could look at the 15-minute as well. That's probably going to be in a nice trend. And so it is. Candles are a little bigger than what I like, but once we get a bullish candle in the buy zone on that higher time frame for natural gas, you'll see a lot more. Probably the same as crude. The 2-hour and the 1-hour are probably going to be the better time frames to trade by the end of the week, and those would be the ones that I'd be looking for. So if it sets up bullish on the weekly chart, you'll start to see all the moving averages in alignment. You'll see price action trending up. and probably the same on the 2 hour. And that's how that would work out. Let's see if there is anything else to look at here. Those were mainly the things that I wanted to talk about. Let's see, didn't plan on going through any Forex. But since we've got some time, let's take a look at, let's see. Actually, let's take a look at some indices. A lot of you folks are probably also tracking, the equities markets. A lot of folks are interested in what's happening in stocks. That tends to get the most attention. And so here again, great examples of a good trending structure. See how different this looks than any type of a sideways market that's testing a high and a low. These trends are very strong. They tend to run for a long period of time. All the moving averages in alignment. Pull back into the buy zone, the moving average zone, but we're not getting any type of a bullish signal here. The weekly chart has completely rolled over, which both charts now will cancel each other out. The 50, the 20, and the 10 are running to the downside. The first lower high here, a breakdown to the first, or the first lower high here, and then a breakdown to the lower low, then another lower low, and we actually had a retest, kind of peek through there, basically a retest of that high, and then a breakdown through the lower low. So now we have lower highs, lower lows, lower high, and a lower low. Now we're right back in that range at around 3,900 to 4,000. That's right back into a Fibonacci retracement, right at about 50% between that swing high and that swing low. This is going to be a great test to see if the rally continues. I think it's probably going to sell off at this Fibonacci retracement level right here. That's usually an obvious point. I think at least it's going to retest this level. I think in the cards, more than likely, the market sees probably 32 to 3,500 over the coming weeks in terms of equities. If we went here and looked at the daily chart, you'd see even more of that trend continuing and everything aligning. We're right back up into the moving average zone, setting up a very bearish indecisive candle right here, right up against that 50%. Let me put that in here actually for you so you guys can see it, see what I'm talking about. Fibonacci retracement, that'll be from right here to right there. And so when you draw that like that, then the bounce on the overextension from the moving averages, when price is down here and the moving averages are probably right around here, that's overextension from the average. Usually it snaps back, and when it snaps back into that 50, 61% zone. And usually that's where it'll start to set up a bearish candle, which will be right within that sell zone between the 20 and the 10 period moving average, which it's doing again right there. There is a slight level right there. You can see a number of touches right in around there that are coupling together with that 50%. So there is some price congestion right around that level as well, which can cause people to sell any positions that it might have been long from down here. So you have those people taking profit. Then you have other people that might be engaging the markets in a net new position, going short at this level because of this kind of a setup. Okay. All right, so what else do we have? Everything here on the daily chart is still converging to the downside. Indicators appear to be going flat. Indicator, everything is still converging to the downside, means everything is still strong. There's no divergence as of yet. We can look at the 8 hour as well. That should be, it was in a downtrend, as you can see. Very nice downtrend, actually. And all those bearish candles setting up right in that zone. But since we've got this rally right here, then the 8 hour is going to be trending in the opposite direction. And so we're going to be left with the weekly and the daily, two side-by-side time frames moving to the downside. And that's that's pretty much how the equity markets look more than likely going forward. Okay. All right. So let me log out here. And then let's take a look and see if this is really going to conclude our session for today. For those of you that still have some questions, I'll stay on a while longer to get those answered for you. See a few questions setting up in the box. I'll get to those in a minute. For those of you that are leaving the webinar at this point, there's a short survey as you exit. Please take a moment to fill that out. Let us know if you found the content useful. We're always trying to improve and deliver content that's valuable to you. So let me, one of the questions is, how do I join your course? Well, let's take a look. This is the first time that I've been doing the sessions for ICM. So let's take a look. And see what they look like. They should have them on the. Let me get here. Oh, come on. ICM markets. Okay, so here they should have, let's see. Where did they put the education at? Education overview. So let's take a look. Advantage of Forex. Let's try webinars, and then we'll take a look at week ahead and see what those might be, the videos. So upcoming webinars. This is this one right here that we're doing. How to trade oil, that one's today as well. The commodities markets are coming up. So there are a number of these that are coming up. Some of these, as you can see, are Trade with Precision. Some are others. So they have a number of different presenters here. I don't see anything here on, and I didn't have the opportunity to check the upcoming calendar. Let's check previous and see if we can. A lot of times we either run these monthly or we run them quarterly. Let's see. I don't see them in here historically. What I would do is get a call into the 1-800 number at ICM and ask them if they have advanced trading strategy courses through Trade with Precision that they're offering. And then that would tell you whether they've actually contracted with us to do that. And that would be your best bet. Before I do the next webinar, I'll take a look at the calendar to see what that looks like. I don't have, let's see, I don't have that in my shared folder. So there's fundamental analysis. We don't do the fundamental. We just do technical. And then let's see, Forex Trading 101. Maybe Trading Plan 101. Maybe these are some of the ones. Let's take a look. Yeah, it does appear that we have some of this technical analysis stuff, like the Trading Plan 101, Trading Psychology, Risk Management 101, Fundamental Analysis, technical analysis. Looks like a lot of our stuff here that we teach. So so check in with the 800 number and see if they have that, and that would be your best bet. Yeah, so it looks like they're there. Maybe they're only doing videos and they haven't contracted with us to do advanced strategy courses. We may still be in talks with them on that, but I'll make sure to check the calendar for next time and see and check with our person who manages the ICM, Trade with Precision relationship, and see if we're actually doing that with you guys, because we normally do, but I'm just not privy to the information. So this is the first time I'm actually doing ICM webinars. All right. Any other questions before we wrap up that I can answer related to some of the markets or some of the strategies I was talking about? Or are you guys ready to wrap it up? So if you're interested in more of these sessions, right where I went on that education section on the webpage, take a look at those. We've got across all markets. We'll be doing those, looking at CFDs, looking at a number of different trading vehicles, and seeing where trading opportunities exist using the technical trading strategies that we teach. Great, glad that you guys enjoyed the session. Glad you learned something from it. Appreciate the compliments. Thank you very much. So look forward to chatting with you guys again. Not sure who's doing the next session, but I'm sure it'll be another person from our team. Anything else that I can answer for you before we wrap up? You will be receiving the email invite to the recording within 24 hours. So stay tuned for that. If you don't see that in your inbox, more than likely it's gone to your spam folder. So make sure you check that. Sometimes it ends up there, and then you can rescue it from there and log in and take a look at some of that technical analysis that I was going over if you want a repeat of that. Okay, anything else before we wrap up? Going once, going twice. All right, well, I think we'll wrap it up at this point. Thanks again for attending. Thanks for the Q&A. Look forward to talking to you guys again and have some safe trading out there. Take care.